This next installment of Not Min Notes will focus on complex option strategies. If you haven't already watched it, you should go back and watch the previous one on basic option strategies, because that helped discuss setting up the approach to each of the questions. And that approach applies to these complex positions as well. So you should definitely plan on watching that one before watching this unit on complex strategies. Let's start with a hedged position. What does it mean to have a hedged position? That consists of a stock position. You can see we're short the stock here. And it consists of an option. That's a hedge. We have a stock and an option. And the first thing you have to do for any option strategy, as was previously discussed, is figure out the attitude of the investor. Whenever you have a hedge position, the attitude is always going to be based on the stock position. The attitude will always be based on the stock position. So in this case, we sold the stock short. Whenever you sell stock short, you're bearish. You want the stock to fall. Okay, why do we have that option? It's just a hedge. It's just in case the thing moves the wrong direction. It's kind of like having insurance. You still want the stock to go down, but just in case you were wrong, you've paid $3 for some insurance. Okay, so for example, let's say the stock goes down to 10, and what you're going to do here on these multi-position strategies is evaluate each position one at a time. So we sold the stock short at 67. Now it's worth 10. Is that good or bad? That's very good. When you sell stock short, you want it to fall. So we made $57 on the short position. On the call option, we have the right to buy the stock for 70. Do you want to buy the stock for 70 if it's only worth $10? Definitely not. So the option expires. So we made 57 on the short. The option expired, but don't forget we still paid our $6 premium for the option. So overall, we made $51 a share. So you evaluate each position one at a time. First position, second position, and then you deal with the premium. First position, second position, premium. Okay. Let's say on the other hand, the stock goes up to 95. Again, first position, second position, premium. So on the first position, on the short position, we're short the stock at 67 and it goes up to 95. Well, that's bad, because if you're short stock, you want it to go down. So we're going to lose 28 on the short. On the call, we have the right to buy the stock for 70. Do you want to buy stock for 70 if it's worth 95? Absolutely. The option is in the money. So we buy the stock for 70. It's worth 95. We make $25. So here's what happens. We lost 28 on the short, first position. We made 25 on the call, second position, and we paid a $6 premium. So first position, second position, premium. So overall, we lost $9 a share. And that's why this is a hedge, by the way, because you can see here that even though we lost on the short, our loss on the short was partially offset by a gain on the call. That's what a hedge means, because without the call, we would have lost even more money. And for the break-even point, we initially paid a $6 premium. We paid a $6 premium. So we got to earn $6. If we want to get back to even, to flat, right now we're $6 underwater, so we got to make $6. And what would have to happen for us to make $6? Well, you got to look at the stock here. We are short the stock for 67. We're short the stock for 67. So for us to make $6, when you sell stock short, what do you need to happen for it to profit? You need to go down. So we're short the stock at 67. So if it goes down to 61, we would make $6, which would offset the $6 premium that we paid. So whenever there's a stock position, the break-even is always based on the premium and the stock. You look at the premium, you say, all right, how can I offset that based on the stock position? Let's discuss another complex position referred to as a covered call. In a previous installment, we talked about uncovered calls. The risk is if the stock goes up, well, you got to go into the market and buy it for whatever it's worth and deliver it or sell it at that lower strike price. So how can you anticipate that that might happen and protect yourself? Well, what if you already own the stock? So in this case, what if we already own the stock and we bought it at 26? Well, that mitigates the risk, because that way if the stock does go up, let's say to 100 or 40 or 60 or whatever, well, the investor, we sold the 30 call, so let's say the stock goes up to 50. The investor says, all right, pal, I'm calling it away from you for 30. You got to sell it to me for 30. We say, all right, no problem. We'll give you the stock. We got it right here in our back pocket. We already bought it for 26. So you don't actually have to go into the market and buy it for 50. It's called a covered call. For example, let's talk about a few scenarios. Let's say the stock between now and May, meaning before expiration, the stock goes up to 50, just as we spoke about. So in this case, the option is in the money because the market value is above the strike, but you wrote it, so that means you have to deliver the stock. It's called away from you. So you have to deliver it for 30, but what price do we pay for the stock? We bought it for 26. So we actually make $4 a share because we bought it for 26. It's called away for 30. So therefore we make the $4 difference. And we also made the premium because if you sell an option, you get paid. So we made that $7 premium. So overall, not too shabby. We made $11 a share. In the second scenario, let's say the option expires and then the stock goes up to 50. So now the option is gone. It expired, and then the stock goes up to 50. Well, that's great because now we get all the upside on the stock. Right, we bought the stock for 26. It's worth 50. We make $24 on the stock, and we made the premium. So the second scenario is the best scenario. And even if the stock drops a little bit, let's say the stock falls to 15. Well, we, again, first position, second position, premium, just as I spoke about in the previous slide. On the first position, we bought the stock for 26. Now it's worth 15, so we're going to lose 11. On the second position, we sold these May 30 calls. Stock's worth 15. So again, when the market value is below the strike, the option expires, but we keep the premium. So we're out $11 on the stock. The option expired. Then we made our $7 premium. So here we only lose 4. So what's the best case scenario here of these three? Scenario number 2. And what do you need to happen? You need the option to expire to achieve scenario number 2. So you need the stock to stay below $50 between now and May. Below $30. You need to stay below $30 between now and May. You need to stay out of the money between now and May. So your attitude is really neutral to slightly bearish. Until when? Until May. Then long term you want the stock to go up. But over the near term, you're neutral to slightly bearish. And if you think about it, we didn't get in a lot of trouble with this position. None of these scenarios is that bad. In the first one, we made money. The second one, we made more money. And the third one, we lost, but we didn't lose as much as we would have if we didn't have the option. Because without the option, we would have lost $11 a share. So selling covered calls is a fairly conservative strategy. You can do it in almost all options accounts because it's fairly conservative. You're not going to get in a lot of trouble by selling uncovered calls. Let's go through one more complex position, specifically a spread. What is a spread? A spread consists of two calls or two puts. It consists of two calls or two puts. Okay. So we're going to buy a June 35 call at 4, and we're going to sell a June 45 call at 2. Okay, so two calls or two puts, in this case two calls, and you buy one and you sell one. First thing you're going to do with the spread is aggregate your premiums. Okay, so we bought the first one and paid for, because you got to think we bought it, so we paid for. Second one we sold and collected $2. So we paid $4, collected $2, so overall we paid $2. And whenever you pay your net premiums, that's called a debit spread. Whenever you pay net premiums, that's called a debit spread. Okay, also, remember I said you have to identify your attitude. In a spread, your attitude is always based off the dominant position. What is the dominant position? It's the option with the higher premium. That's why I put a star here to indicate the dominant position, because that's the option with the higher premium. Okay, so we are buying a call. And when you buy a call, you are bullish. And all spreads are moderate positions. We are moderately bullish. We're reducing our investment. Instead of paying 4, we only paid 2. But because of that, as I'll show you in a second, we give up some of the upside. So all spreads are moderate positions. So it's bullish because of the dominant position. And we know we're moderately bullish because it's a spread. Now, if I were to ask you max gain, max loss, and break even, it's the same song and dance I've been doing in all these examples, single positions and the hedges and the covered position. Maximum gain, well, if we're bullish, we want it to go up. So let's say the stock goes up to 100, and same exact exercise. First position, second position, premium. First position, second position, premium. So the market value of 100, we bought a June 35 call, so a 35 call is in the money. And since we bought it, that's good because we can buy the stock for 35 bucks. So we make 65 bucks on the first one. Now the second one is also in the money because it's a 45 call. Remember, calls are in the money when the stock goes up. However, because we sold it, that sucks. We're on the wrong side of the trade. So the stock is called away from us. Yeah, the stock is called away from us. Okay, for 45, and we got to get it for 100. So on the second one, we lose big time. We lose 55. So first one, we profited 65 on the June 35 call. We lost 55 on the June 45 call. We paid a $2 premium. We paid a $2 premium. So again, first position, second position premium. So overall, our max gain is $8 a share. And here you can see I said you give up upside. Absolutely. Because normally if you buy a call, your max gain is unlimited. But here, well, if it goes past 35, we're happy because we start to profit. But once it goes past 45, for every dollar past 45, we have offsetting gains and losses. So that's why our maximum gain is just the difference between these two, because we profit from 35 to 45, and then past 45 we're capped, minus the $2 premium that we paid. So that's why our maximum gain is $8 a share. Okay, max loss. Well, if we're bullish, we want it to go up. So what are we going to lose? If the stock goes all the way to 0, and check out how easy this is. At a market value of 0, what's the status of a 35 call? It's out of the money because the market value is below the strike. What's the status of a 45 call? It's out of the money because the market value is below the strike. The fact that you bought one and sold another one doesn't make a difference. When the market value is below the strike price for a call option, it is out of the money, no matter what. That's why it's so important, as I alluded to in the previous lecture, to understand this notion of in the money and out of the money. So both options expire and we just lose our premium. And finally, for break even, just like before, we paid a $2 premium. We paid a $2 premium. Right? That's our $2 net premium. So which option do you think the break even will be based off of? Well, it's going to be based off the dominant position. So we paid a $2 premium, so we'd have to earn $2. And to earn $2, what needs to happen? Well, it would have to go up $2 from that strike price. We're bullish, right? Don't forget you're bullish. We are bullish. So we want it to go up. And it would have to go up $2 from that $35 strike. So therefore the break even would be 37. So the break even for a spread is always based off the dominant position. And you see the whole setup here looks just like the simple strategies that I did in a previous lecture, just like the hedge, just like the covered position. So the key to options on the exam is consistency in your approach. First position, second position, premium, and also really understanding what it means for an option to be in the money or out of the money. If you want to work through that, you'll be able to get the options questions on the test. A lot of it's practice. You don't want to start memorizing formulas or memorize charts. You want to understand the approach and the terminology. That concludes this installment of Notman Notes. As always, if you have any questions, feel free to contact us. You have my contact information on the second slide. Feel free to repeat and rewind to review concepts. And as always, best of luck on your examination. Thank you.